Gracias a los presidentes de Asofiduciarias, Asobolsa y también la Bolsa de Valores de Colombia. Para mí es un gran placer estar en Colombia con ustedes hoy y para poder compartir unas perspectivas sobre tendencias globales y también espero poder contribuir a la conversación de la misión de los mercados capitales. Pero antes de empezar, les tengo que decir dos cosas. Primero, tengo buenas noticias y tengo malas noticias. Las buenas noticias es que voy a hablar en inglés para que no pueda cometer muchísimos errores en español gramaticales. Lo siento, pero voy a hablar en inglés. Las malas noticias es que he decidido que vamos a tener un pequeño examen, un pequeño quiz después de mi presentación. O sea, ustedes tienen que prestar muchísima atención because I reserve the right to call on any of you at any time. Ok, con esto, lo que quiero hacer es compartir algunas investigaciones que hicimos en los últimos 5 años en Europa y también si tenemos un poquito del tiempo después de terminar mis comentarios, encantado tomar unas preguntas si tenemos tiempo. Ok, vamos a cambiar a inglés, lo siento. For the last roughly 5 years, we've done research among wealth managers in Europe, we've done research in America, and in Asia to understand what are the major trends that are impacting wealth managers and to track how have those changes evolved over time. And so what I want to start with is give you a sense of where were we sort of 5 years ago, how are some of these trends changing, and along the way to think a little bit about how do these trends potentially have implications for Latin America and for Colombia, and you'll be the judge of how soon you think these trends are coming. And I think what I really want to do today is not so much to challenge you to think about whether these trends will or won't happen. I think they will happen. The question is, how fast will these trends come? And I would submit to you from experiences in Europe and in America that very often we underestimate how fast these trends come. And so I think the question to think about is, are you prepared for these trends? If they arrive sooner than you think they will, what is your plan to lead rather than to react to these trends? And so that, I guess, is the challenge I would ask you to think about as we reflect a little bit on some of these broader trends. So what you can see here is what has changed between 2014 and 2018 among wealth managers globally. So at the top, you can see that regulation was, for many years, probably the most significant trend, the most burdensome issue facing wealth managers. And if you focus a little bit on Europe, you've probably heard about MiFID II, you may know a lot about Dodd-Frank, and so regulation has been a very significant challenge for wealth managers up until now. Of course, pressure on margins and technological change have also been important, and I think what was very surprising in 2018, if you look at the bottom of this chart, you can see that regulation is no longer the dominant trend, and wealth managers have said, how I deal with technological change, how I deal with digitalization has become the defining issue. How will I digitalize my business? How will I serve my clients in a different way? How will I create value for my clients more efficiently than maybe I've done in the past? And so this is just to set a little bit of the context around some of the bigger pictures around regulation, margin pressure, and technological change. And so as a consequence of both some of these fee pressures, as a consequence of rising costs, wealth managers have been thinking, how will I evolve my business model? What will I do to become more efficient? What will I do to enhance my value proposition? And if, as a wealth manager, I was accustomed, for example, to making most of my revenue from commissions, and I'm going to move to fee-based, how will I manage that transition? How will I deal with what could be a very disruptive process of moving from brokerage to fee-based? And I'm going to spend more time later talking about that transition to fee-based because I do think it's one of the defining trends, certainly first in the US, then in Europe, and now potentially here, soon in Latin America and in Asia. The other point I would make, the other trend that we saw very clearly is that for many years when investors were thinking about buying a fund or putting a fund on their platform, they would typically focus almost exclusively on the performance. What was the performance of the fund over 1, over 3, over 5 years? But that conversation has changed too, and it is no longer simply about performance. Investors are asking, what is the price and what is the cost of that investment? And so this is becoming another very important component of people's decision-making around the world. And so this is, I mentioned fee-based. I want to spend some time on this because I think it's important, and I think there are a lot of very important lessons that we can share here. The first is that when clients think about moving to fee-based, often the question they'll ask, and I should define what fee-based means because perhaps here in Colombia you use a different definition. When I think about fee-based, I think about investors choosing to pay a fixed fee, usually a percentage of assets under management, for someone to manage their assets on their behalf. And so when I worked at Merrill Lynch in the United States 15, 16, 17 years ago, that Merrill Lynch at the time decided that we want to move from brokerage or commission to fee-based. And many of these larger, they call them wirehouses or broker-dealers, made the decision to move to fee-based, not because the regulator told them that they needed to make the change, but rather they believed two things. They believed that one, it would better align their interests with their clients' interests, and I'll talk about that alignment. And two, they also believed that it would create a much more predictable revenue stream. And so if you think about your own revenue stream, if you are a broker-dealer, when markets are good, you might have quite significant inflows. When markets are bad, you get a lot of volatility in your revenue. And so the question is, how do you create a more stable revenue stream over time? And so fee-based is certainly one way to think about this. So when I think about what was propelling this move from brokerage to fee-based, it certainly was, it aligns well because the client is paying typically a fee, a percentage of assets under management. If those assets increase, obviously the wealth manager will get paid more. If the assets were to decrease, then the wealth manager would get paid less. So this is a little bit about the alignment that I was talking about. The second thing we see very clearly in the transition in the US, we're seeing this now in Europe after MiFID II. So MiFID II did not eliminate commissions in Europe. But what the European regulators said was, we want transparency. We want clients to know very clearly how much money are they paying for financial advice. And in order to achieve that, they said that when you receive your statement in the mail, at the bottom of the first page of the statement, it's going to tell the client in euros how much money did you pay for advice. That is a new development. That never existed in Europe before. And in fact, most clients probably didn't know what they were paying, and if they did, they tended not to focus on it. So this price transparency has come a long way towards pushing people towards fee-based advice, and we see this very clearly in the US. The other point that we see as a consequence of moving to fee-based is that very often wealth managers will say, okay, I'm more conscious about my manufacturing costs. What is it costing me to manufacture funds for my investors? And so you will see also a very pronounced trend towards using index and using ETFs in portfolios, not only because they believe it's potentially a more efficient way to allocate assets, but also because it can reduce the manufacturing costs for the portfolio. So another consequence of fee-based is a much greater adoption of ETFs. We clearly see this in the US, we see this in Europe, and we see this globally. The other point I think that's important to stress too is very often when you move to fee-based, you want to focus on model portfolios or discretionary portfolio management. And what I've put here is a chart, and this is really a chart that comes from Europe, and it shows you the general direction away from traditional advisory, so think brokerage, towards fee-based advisory and or discretionary mandates. And so this is very much the trend, and wealth managers, certainly in Europe and in the US, want to move more and more to discretionary management, both because it's scalable, they believe they can deliver a better experience to their clients, and it gives them also a better way to govern the risks around their portfolios. They can monitor those portfolios better rather than having hundreds or thousands of clients with different portfolios for different reasons. And you can imagine in Europe, the regulator could come and say, why does one have this portfolio and Camila has this portfolio? They're both the same age, they have the same risk tolerance, but they have different portfolios. Why is this the case? This is a case in Europe, and so you need to think about how do you have more consistency in the portfolios that you deliver to your clients. And so the move to fee-based is significant. I would submit to you it's definitely coming. And one of the reasons why I think it may come sooner rather than later is many wealth managers, particularly those based in the US, who work for large broker-dealers who are already embracing fee-based, are going to be talking to their clients in Argentina, in Colombia, and in Mexico. So they're going to be knocking on the door of the clients here and saying, I've got a different proposition for you. This is what a fee-based proposition looks like. Doesn't this align better with what you, Mr. and Mrs. Investor, want? So irrespective of whether you believe you need to move to fee-based, other people are moving to fee-based, and that's why I submit to you it's something that you need to pay close attention to. The last point I would make, many people will say, well, it's really hard to transition from a brokerage model to a fee-based model. How do I talk to my clients about this? How do I do that? Where do I start? This is complicated. And the answer is, yes, it can be complicated, but I think there are a few very important points to stress from past experience. One is, my experience has been that clients are always willing to pay when they see value for money. They typically won't question a move to fee-based if they can assign a value to the advice that they're getting from their advisor or from the institution that they work with. And so thinking about what is your value proposition, not only what differentiates you from the competition, but what can the client tangibly point to say, this is the experience I get working with the person that I have. And so making sure that value proposition is robust, is strong, is very important as you think about moving from brokerage to fee-based. And the other point, I suppose, that's an important lesson from Europe is that not every client wants the same amount of service, not every client wants the same experience, and so you might have to have different contracts for different clients that deliver different levels of service. So some people might want one phone call a year and they want their reports. Other people might want to talk to you 5 times a week. They want a specialized portfolio manager. They want everything. And so you have to think about how you would price that fee-based relationship for different levels of service. Next thing I would say, so I mentioned the rise of model portfolios. This is a trend that started in the US, particularly in the US where you have roughly 300,000 financial professionals, many of whom can choose how they wish to manage their clients' investments. But when I told you that US broker-dealers were making the transition to fee-based, and I told you that one of the consequences of that transition is looking for a more scalable, efficient way to manage clients' money, and looking for ways to deal more of a to provide mass customization, models are one way that can be very effective to manage a large population of clients. And whether you often can think about models today as largely being populated with ETFs, both, again, because many wirehouses believe that what I want to provide my clients is my asset allocation advice. I'm less perhaps focused on manager selection. And 2, maybe I want to deliver that portfolio at a lower cost, and therefore I see ETFs as one potentially very convenient way to build model portfolios. So you can see some numbers, nearly $2 trillion in advanced customized model portfolios, another $500 billion with wealth managers. This is definitely a major trend. It's coming to Europe, and again, I think we will see more of this in the region as well. This is really interesting. So many of you probably are familiar with the names Vanguard, Schwab, Merrill Lynch, Edge, TD Ameritrade, but this gives you some sense of what is happening in the world of digital advice or digital platform advice. And so I want to take just a couple minutes and talk about this and what are we seeing, why are we seeing this, and then maybe what are some of the implications for Latin America and for Colombia. So I think what was really surprising to me is not just how many assets are going into these platforms, but look at the prices in basis points that are being charged for advice. And I would suggest that some of these are a lot lower than we may be accustomed to looking at in the past. And so I think Vanguard in particular has done an outstanding job in the US. They've built a very significant business, and I would suggest that one of the reasons why they've done a very good job is they've had an excellent digital platform, they've had an excellent offering, and they've tapped into something that many people have seen in the US, which is there's a large group of baby boomers. You're probably familiar with the term. So people who are over the age of 55, who are thinking about retirement, who typically have significant assets and maybe thinking, who do I trust to manage my assets in retirement, and who's going to manage those assets at perhaps a lower cost? And so retirement isn't the only reason, but it is certainly one reason why you've seen a very significant growth in digital platforms capturing this. You've also would note that convenience is very important. People want to access their portfolios when they want to. They want to do it in a simple way, and they want to make sure that they can get immediate feedback. And so this is a trend that is gaining prominence. This is a US snapshot. I suggest this is happening in Europe. In Europe, mostly the banks have decided to create their own digital platforms. Sometimes people will use the word robo-advisor synonymously with digital platforms. But this is very significant, and it has significant implications if you're a wealth manager for your segmentation. So some of your clients, perhaps your wealthier clients, don't want to work on a digital platform. They want to talk to an advisor. They want trusted advice from a human, and there will be a significant number of people who will want that. But there may also be segments of people who want to interact online, and we'll talk a little bit about the millennial generation in a minute, but some people will want to interact this way, or you might conclude that it's actually not cost efficient to serve a whole segment of your clients. In the US, this number was initially $250,000, and I would argue that number continues to come down. And so you really need to think about which clients need to be served by people, which clients need to be served by a digital platform, and I think the big debate that we've all had for many years is, what about this hybrid model where sometimes I want to talk to a person, but sometimes I want to interact on the platform, and it's up to me to decide how I, as an investor, how I want to interact with you. And so giving your clients the choice to not only interact with a person, but also with your platform, I think is going to be a very significant issue for all of us as we go forward. So I have an interesting question, and we'll put this by a show of your hands. So how many of you would be willing to let Google or Amazon, let's pick those two, manage your personal wealth? 5%, 10% max. Okay, let's see what a study from Capgemini tells us about this. So first of all, in the US, almost 3/4 of millennials would be willing to buy financial products from technology companies. And this is the one that really got me. 82% of high net worth investors would consider Google, Apple, or Amazon for their wealth management needs. Who knows? But the question is, if they do come and they do show up, are you prepared? So I thought that was interesting, and at the end we'll see what else we can say about this. But I thought that was an interesting statistic and says a lot about how our preferences at different age groups evolving. Because I would have argued 15 years ago, I would have said, no, who would ever consider doing that? But now actually a majority of millennials want to interact that way. And so the next generation of investors need to think this way. And I was talking to Diego this morning, and my colleague Diego Mora, and he was saying, look, the demographics in Colombia are obviously very different. You have a much younger population here. You have people who have grown up on the iPhone since the age of probably 3, who are very comfortable navigating digitally. And so how will we serve this generation differently than we served the past one? That's the question, and that's why I think it's not about human or robot. It's really about how do you have a bit of both. So I want to talk about something that took Europe completely, I would argue, by surprise. So 5 years ago, if I was talking to a wealth manager in Frankfurt, Germany, or in Stockholm, Switzerland, or in London, or in Paris, and you ask them, what are you doing with socially responsible investing, or what are you doing with ESG? Most of them, 3 to 5 years ago, would have said, yes, I have a few socially responsible investments, but it is not a strategic priority for me. This topic, ESG, environmental social governance, has experienced a meteoric rise in Europe. It has gone from practically not on the radar screen to a board-level issue, to a strategic issue, and I think we personally, as an asset manager in Europe, probably don't receive an RFP today that doesn't ask us, how are we incorporating ESG into our investment process? So this clearly has more prominence in Europe than it does in other parts of the world, but it's growing fast. The regulators are looking closely at this, and I think there were a couple statistics I noted as I was looking at the Financial Times this weekend that I think underscores this. So first I'd say I was reminded by a study that Morningstar did. And so one of the biggest objections, or one of the biggest areas of skepticism about ESG has been that, well, if I invest in ESG, I have to sacrifice performance. I'm going to lose some performance if I invest in ESG. And what Morningstar has shown is that actually 35% of sustainable funds have ended up in the top quartile, and 63% made it into the top half. Now, we could debate the methodology, we can debate why this is the case, but what we must admit is that increasingly, investors believe that they may not have a penalty for investing in ESG, and they actually want increasingly to understand how will their asset manager or their wealth manager invest and manage their assets in a sustainable fashion. And if you don't believe this is a trend, then I tell you that 168 sustainable funds have been launched in the first 6 months of this year, after more than 305 sustainable funds were launched last year. Now, the quantity of funds doesn't speak to you about necessarily how fast the trend comes here, but it says to you this is an issue that is growing in importance, and I have spoken to many family offices where the second generation, so the second generation in Colombia, in Brazil, and in Mexico, says, you know what, this issue matters to me. My father or my mother might not have cared about that issue, but I care about that issue, and I want to know, how are you going to manage my assets? And so this is a topic that is gaining interest. You will know better than I will whether your clients and your colleagues are thinking about this, but this one, I submit to you, is definitely coming our way. And on a personal note, in that same article that I was reading about the growth of sustainable funds, it reminded me that the hottest month in recorded history, since they started recording temperatures globally, was this month of July. So we can debate whether climate change is happening, but we just had the hottest month we've ever had, even though when I arrived in Bogota, day before yesterday, I needed a jacket. It is getting hotter in most places. So a couple more comments. Alternative investments. So this has been another trend that we have seen gain very significant prominence in the last couple of years. And we can talk a little bit about what's really propelling interest in alternative investments. And I would suggest there are a couple of reasons, some of which you will perhaps be very familiar with. The first is people's return expectations have been going down. And if you think about living in Europe, where you also have negative interest rates and may continue to have negative interest rates with $17 trillion of government bonds in negative territory, which is an astounding figure to me. Against this backdrop, clients are struggling to figure out how to generate yield. The second thing is, while we can debate, again, the methodology, there is certainly some persuasive evidence that private markets can outperform public markets, and so people are increasingly thinking, how will I incorporate alternatives in my portfolio? And what we see among institutional investors, but also wealth managers, is that they intend to increase significantly or increase some their allocation to private equity, to real estate, to real assets, and to private credit. We at BlackRock have certainly seen this to be true, and certainly we are, as an institution, spending a lot of time thinking about how we can help our clients make alternative investments a more predictable and regular part of their allocation. And I think this is an important point to stress for wealth managers. So I saw this piece of work that was also done that shows what is the gap between what CIOs suggest the allocation to a client, that a client should have to alternatives, versus what the client actually has allocated to alternatives. And you can see this gap quantified in aggregate is roughly 5 trillion, and simply says CIOs would say, Mr. and Mrs. Client, you should have, pick a number, a 10% allocation to illiquid investments if you can tolerate that. But the average client may have 2 or 3% of an allocation to alternatives. And so I think part of the experience for many clients has been that they were sold an individual fund. They were sold a private equity fund, they were sold a private credit fund, but nobody really talked about how does that fund fit within your portfolio? What is your strategic asset allocation to alternative investments? How do you think about tactical allocations to alternative investments? And so I think the debate is shifting from I sell you a product to I think about the role of alternatives holistically inside your portfolios. So I think with that, Diego, anything that I've missed so far? Okay, so we've arrived at that fun moment where we're going to have a pop quiz. We're going to have a little test, and then we'll take some questions. So who here can remember how many clients under the age of 40 were willing to let Google and Amazon invest their assets? Who remembers the statistic? 82. Excellent. Okay, now here's the next question. This is a very important question coming from a guy who's now living in New York. And if you're from Cartagena, you can't answer this question. What is the name of the Colombian-born in Cartagena, baseball player who plays third base for the New York Yankees and whose batting average this year is 338? Yes, we got it. So anyway, I watched him play last week, and he's an awesome baseball player. And so I know you're probably more focused on who won the Tour de France this year, which was amazing, but I was pretty focused on this guy playing third base and hitting 338, which I thought was pretty great. So I was told that nobody is going to ask me a question, but nevertheless, I'm very happy in the few minutes that we have. If there are any questions, I'm happy to take some. If you want to talk afterwards, I'm delighted to talk with you afterwards. If you want to send me an email or connect with me on LinkedIn, you can do that. But again, if there is any questions now, I'm very happy to take a couple of questions in the time that we have. Let's see if everyone was right. There will be no questions for me. No questions. Okay. Well, I guess if there are no questions, you are going to have time for another cafecito now before the next speaker comes. And I would say thank you very much for the invitation to be here today.